The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to this special edition of Digging into the BI, where we're going to be looking at some of the stocks that we presented over the last year and a half and wanted to be able to see how our judgments held out and the like. So anyway, there were a whole bunch of stocks we looked at, and you can sort of see the NASCAR look of that front page. Let's go to the next page, and can we get this into presentation mode?
It is already.
It is?
At least it is on my screen.
No, I don't see it as full. Anyway, let's go to our next.
I don't see it either.
Yeah, I see it in just a
All right,
slide.
hold on a second. We'll do that again. That's easy.
Technological glitches there, folks. We'll get it.
How's that?
Still the same.
It's the best I can do. Sorry.
Then
Product
that's what.
activation failed at the top.
Say that again, Ed.
Product activation failed at the top. It may be disabling you from going into display mode.
Okay. All right. Well, we'll work through this, folks. No problem. Let's go to our next slide.
Okay, I've got us there. Disclaimer.
Oh, mine's a little slow. I'm not seeing it. Okay, so here's our standard disclaimer in the Better Investing community. We are doing this for educational purposes. Whatever stocks we talk about, whatever sites we look to, those are, those are not endorsements or recommendations of those. So go ahead and do your own research, but that's basically what our organization is all about. Next slide.
Okay, I think we need to go. Ed, you need to tell me where this thing is that I'm looking at. Is it on the slides, or is it in the menu of the go to webinar?
The thing I'm only seeing the main page right now. I haven't seen anything else show up.
But where do I go to that thing that you talked about that's blocking me?
If you go,
Well,
I think under slideshow, try slideshow, which is fourth one over,
F5.
home, insert, design, transition, animation, do slideshow.
Okay. Let's put that in from the beginning. Now, are you seeing me move to disclaimer?
No, I have not. It looks like there's something open behind this, which is probably what's happening, because I can see the backside of your email.
Okay, let me get rid of that then.
Sorry, folks.
No, I don't want to keep going if nobody's seeing it except me. That's not doing us any good.
That is true.
How's that? Am I on the disclaimer page yet?
Nope.
No.
I'm not seeing it.
Ed, where is this place you mentioned that?
What I'm seeing up on top is it seems like the product doesn't. It says product activation failed on the banner up on top. So I'm not sure you're going to be able to use
the banner of the go to webinar or of the
PowerPoint. The PowerPoint slide deck.
All right.
So can we get someone else to maybe pull it up on their PowerPoint?
I can do it. You want to make me the?
I can do that. Sorry, guys.
Okay. Let me know when people can see my screen.
I can see
Got it.
Okay. Sorry about that, folks. So here's our disclaimer. So we're doing whatever securities we discuss. They can be in our own personal portfolios, but again, we're not endorsing or promoting any products. And again, this one will be recorded and put up on our YouTube channel. Again, this is sort of standard, but in case we have some people that don't know who Better Investing is, we are an investment education organization, and you can be able to find out more if you download the handouts. These are hyperlinks, so you'll be able to see and go straight to those locations. We also focus on long-term fundamental investing, and all of us that are presenting tonight are volunteers in the Mid-Atlantic. Again, Better Investing is an investment education where we do learn by doing. There are two people that were there at the beginning, and George Nicholson on the right, and Thomas O'Hara on the left. And we're just carrying on what they've been doing since the 1950s. Here's the YouTube channel. And again, this is a hyperlink up on the top, so it will take you directly to that location. If you go to YouTube and you just type in digging into the BI, you will find it in the search, if you put it in the search window of YouTube. Our goal is to get to 50 subscribers. We did really well last week when we were doing this, but if you can help with the algorithm from YouTube, which is owned by Google, to subscribe and like the videos individually, because that will sort of help drive traffic to it, and we'd appreciate that. If you want to be able to connect with us, and we did have a lot of people that connected with us on the DC chapter Facebook page. We got a lot of shares and a lot of engagement outside the area, so thank you for those people that did it. But you can do it either with the DC regional or with the Maryland chapter as well. But this stuff can also be shared with non-BI members, which is a great way to be able to do some recruitment. Again, for people that are unfamiliar with how to use GoToWebinar, all these platforms are a little bit different. If you see, you're automatically muted, but you can collapse and expand it by moving that arrow that has the orangish tint to it in the background. And then if you want to, you can be able to ask questions, and you can do that by pulling out the question box. It's a little bit easier, or you can raise your hand, and when we get to the end, we will take questions, and Ed will be able to guide us through those things. If you're having trouble hearing things, here's some steps to be able to take a look and go to webinar. The first thing is look at the help, which is the red arrow, and go up there to take a look at it. A lot of times people have trouble with their audio settings. A lot of times it's they don't have the right one connected. If you're on your computer, the computer audio will work. And the like, or you can sit there and just call in on your phone. Make sure to take the handouts, which is that green arrow. We just have 2 handouts tonight, and we'll talk about those as we go through it. One is a slide deck, and one is another part of what we're looking at. In terms of viewing and making things easier, here's the first one is how you can zoom, and under that one, if you see that drop-down arrow next to the 87, you can make it even bigger by having it fill out the entire screen. And if we do say something kind of fast and you don't want to write it down, you can also screenshot it, which is the number 2, and that will store on your computer if you want to be able to remind yourself of during question time what you want to look at. So we started digging into the BI in November of 2020. So that was 14 months through December of 2021. We were always looking at 4 stocks. So we have 56 stocks we've looked at. We had 18 different presenters. We had 6 different clubs presented, and we had 4 individual members. So we really had a broad range, all from either Maryland, DC, or Virginia. So thank you to all of the folks that helped out. And I see several of those folks. Are actually in the audience tonight. So thank you. Here's the first handout, and it may take a little bit of while to see it. But this says what I've done is over on the left-hand side are the original judgments for all the stocks that we presented through December 2021. And so you'd be able to see what type of stock it is, whether it was a stock to study, undervalued feature, whether it was a heat map or what have you, the conclusion, buy, hold, or sell, what the zoning was on it, the total return that's in section 5, who the presenter was, and the stock, again, the stock that it was. After that, in fact, on those, just to make it a little bit easier, the undervalued features are highlighted in yellow. In sort of the light bluish one are the stock to studies. There are 2 stocks that are in red because while they were stock to studies, they weren't presented because we didn't get them in time from headquarters to be able to do it. And then the next column over, the winning selections, those are the ones that the audience selected as the best ones there. On the right-hand side are all the same stocks, but what it is and it's matched up. Those are that's from the Manifest dashboard, which is a separate operation. But what we've done is that we can put in we put in a fake $100 and we can see how those stocks have performed since they were put on there. A lot of those metrics, the sales growth, the projected PE, financial strength, and quality and par, those are features that are unique to Manifest. We'll talk a little bit about it, but I have a couple links there to be able to help you out. The one thing I wanted to point out is where it has a value average of $98.98, and everything is sorted on that red column, which is the value. That's the average of all the stocks we've looked at through December 2021, which means if we started at 100, it means we're only down 1.2% from when we initially did this. With all the things that are going bad in the market, the fact is that collectively we haven't been that far off. Again, you'll see this if you download that handout with a PDF that has a Manifest dashboards on it. Here's just more of the same stuff. This is just a continuation of the next, further down. It's still sorted on the value. And you'll see the ones that we broke even up near the top. And then as they go further and further down, we're losing money. And you'll see some real dogs down at the bottom, like Carnival and Etsy. So anyway, one of the things we talk about in the Better Investing community, it's an unofficial rule, because it's not necessarily a rule per se, but it's been called the rule of 5. And what we say is that for every 5 stocks you follow, 1 will outperform your SSG estimates, 3 will perform equal or close to it, and 1 will underperform. And if you want to know more about that link there to the SSG Digital Handbook, that's where it's mentioned. You can be able to get a copy of it. It's an ebook. Very well worth it. I think it's like $20 or $25 if you're so inclined, just to take a look at it. The origin of this rule of 5 comes from this book. It's Investing for a Successful Future. It was David Babson. In the lower right hand are some links to some information about him, but he was one of the original growth investors, along with T. Rowe Price and Phil Fisher, that advocated back in the 30s and 40s for looking at growth stocks rather than income-based stocks. And this comes from there. And he said it a little bit differently, that he thought that 20% would be disappointing, 40 would be average, 20% would be very good, and the remaining 20% would be extraordinary. So anyway, it's very similar, but I just wanted you to see that origin. So now what we're going to do is we're going to look at all the selections. We'll look at Manifest on the dashboards. And again, we put everything in at the time it came at $100, so we can be able to see it. And we got some performance metrics. And then the others have been put into a portfolio that I keep on in my own account. There's no performance metrics, but what we can see is just sort of the stocks we've looked at and what areas and industry sectors and sizes that we looked at. So the first thing is, here's the Manifest dashboard, is it can tell us which ones have performed best. So there's 4 public dashboards. And if it's a public dashboard, you don't have to be a member of Manifest to be able to see it. So you can be able to take a look at it. And on the next slide, I'll have a link, or in a couple slides, I'll have the links to be able to take you to it. But we have them broken down into the selections from the first year, 2021, the second year that we're currently in, and then those that were selected as the winners from the audience. And you can be able to find that here on the next slide. This is, if you have a Manifest subscription, you can be able to come in there and take a look. You can search on the dashboard by just doing digging and you'll find all 4 of them. Again, if you don't have a subscription, you can if you download this handout and click on that manifest link up there, you will go to it without having a subscription. So here are the 4 actual dashboards. They're public. And again, you can look at them later to be able to take a look, and they'll stay open for you to gather with. So here it is. This is what it looks like. And these were the stocks from 2021. And again, it's sorted on that same price. And you can see that ExxonMobil has gone up 157% since it looked at, because the original price is $100. It's now at $257. It means it's gone up 157%. And it's a quick way to be able to take a look at it. It doesn't factor in, it doesn't annualize things, nor does it factor in dividends, but at least gives you a really quick look at that, and that's what you'll see on the dashboard. With the BI tools is that we can be able to look and see, are we sort of gathering certain types of stocks? Are we looking in more sectors or a particular company size more often? Again, there's no performance metric because I haven't updated it, so we can keep things equally weighted. So here's what all the stocks that we looked at through December 2021 by sector. You can see a lot of consumer cyclical, financial services were really big. And it's interesting that technology and healthcare were a little bit on the smaller side. But that sort of gives you a quick idea. And so keep those colors in mind, because when I move to the next slide, you'll see them as they break down by industry. So those colors are still the same sectors, and you can glance around and see all the different areas that we looked at. So we spent a lot of time, if you look down in towards the bottom where it says bank regional, 5.2% of all the stocks that we looked at came out of that particular area. And so it just sort of gives you an idea to see where we're balanced. And it's not too outlandish one way or the other, but it's just a good quick way to take a look at. Here it is by companies. And again, not all the companies are listed because normally people don't have portfolios of 56 companies like we have that we've looked at, but at least gives you an idea of where some of these stocks are and what's going on. So anyway, that's really it. The final one, and this is kind of interesting, is this is sorted by sales size. And as you can see, the large size, which is green, was really one of the larger ones that are in there. The mediums are the blue. That's a sale size between $1 billion and $10 billion. Quite a bit were in there, but it's really the small ones, and that's where most of us in the orange, we didn't look at that many small companies, and those are ones that have a sales size below 1 billion. And we look at it by sales size rather than by market cap. We could have a long discussion on that, but just to be able to take a look, that's sort of the BI methodology, is to look at sales size because we think it's a little bit more consistent. So here are the 10 stocks we're going to look at tonight. It's going to be ExxonMobil, Edward Lifesciences, Regeneron, Hershey Foods, Ollie's Bargain Outlet. All 5 of those outperformed the market over their time period. And then we have 5 that didn't. And that's going to be Qualys, Nvidia, Medifast, Etsy, and Carnival. So that's where you can sort of see what we have. And what we're going to ask ourselves is that, how did they perform? What did we find that was interesting? Well, we have the original presenters of those stocks, and we'll sort of say, is the sales and earnings growth story still the same? Does your investment thesis still hold? Were there any unforeseen news? Are the fundamentals still there? So we'll spend about 5 minutes with each person getting a look at what they're doing. So again, here's a little look at how we're doing, and that's the order in which we're going to do it. And I'll let you know that once we hit the first 5 after Ollie's, we're going to stop and we're going to have a poll, and we're going to say, of the 5 that were performing the best, which one would you want to do further research? And we'll ask your opinion. And then when we look at the ones that are the underperformers, we'll ask you that question again with the underperformers and give you a chance to vote to see which one you think is more interesting. So with that, why don't we start out? And I'm going to go first with Edward Lifesciences, which came out of the very first presentation we did in November of 2020. And since it was presented, it had an annualized rate of return of 18%. Even with the down market, it still is up 18%. So it's in the New York Stock Exchange. It's to be able to tell you, it deals with cardiovascular health. They deal with stents and valves and angioplasty rings, anything that has to do with the heart. It has that. I can tell you from personal experience, I have it because I had open heart surgery 4 years ago, and I have one of their pieces in my heart right now as we're talking. So over on the right-hand side is the original judgments that I came up with from October when I did this on October 28th, 2020. And you'll see that that price at 73.26 is over in the lower right-hand side and in the upper left-hand side. And that's sort of where we are. The thing is that the 52-week high and lows, those are the current ones. And then the closing price for all of the stocks that we're going to be looking at is going to be Friday or July 15th. Next, you see an analyzed return with presentation, since the presentation, including dividends. That's a hyperlink where you can basically put in any stock and give a beginning and end date, and we'll give you the analyzed rate of return. So that's a little bit more accurate than what you would see in, say, the Medifast stuff. My original forecast for 5-year earnings estimate when I looked at it was 14%. And the latest trailing 12 months, the last 4 quarters, the sales growth has been 19.7, and the trailing 12-month earnings is 80.7. Now, I don't think the rest of the presenters will have to repeat that, but I just wanted you to get a feel for, and that's standard in all 10 presentations we have, that this would be sort of an opening slide so you get an idea of what we're doing. So from my original presentation, here's Edward Lifesciences. They have 4 segments: transcatheter aortic valve replacement, transcatheter mitral and tricuspid therapies, structural heart, and critical care. And again, heart disease is the #1 killer of people in this country, man or woman, it doesn't matter. And so this is a growing industry, and as we age, people are going to need their services more and more often. And as you can see, they have about 60% of their sales are inside the U.S., but they are all over the world as well. And this is from the original presentation back in November of 2020. It has a very understandable business model. It has classic up, straight, and parallel lines mostly. The management is really good. They have manageable debt to capital. It just does really well. And one of its big peers is Medtronic, although Medtronic does much more than just cardiac stuff. So it's not exactly a good one-to-one comparison. What I've done here is these are the recent quarterly figures for Edward Lifesciences. So this is a quarterly data that you can find in SSG Plus. And so what I've done is I've revised up in the top left is the sales growth line. And you'll see that that green straight line across there, that's what I'm estimating for sales now. And if you look at it, the trailing 12 months of sales are the dots that are there. And anytime the numbers are above, it means that it's outperforming my sales estimates. So those are actually pretty good. And you'll see that with those 4 dots over on the right-hand side in the one that has a green arrow, let me put this right here so you can see it, these 4 dots, those are basically, that means they're outperforming, and that's a good sign. If we look at over here on the right-hand side, this is a pre-tax profit margin. It bounces around, but it's still a very solid number, and it's still pretty consistent for the last 4 quarters, 1, 2, 3, 4. When you look at the earnings, again, here's my earnings growth number, and these numbers are basically blowing the doors off of it. They're doing really well. And that gets to sort of what Edward Lifesciences is that I've looked at this company, not just in November 2020. I've looked at it off and on for over 20 years, and I can never find it at a good price because my original presentation, I had it as, I just didn't see a lot of growth. The original thesis was it was a growth company. It's excellently managed. It's rarely on sale. Part of it is because it's such a high quality company. So the best you can do is to be able to sit there and be patient and wait for a price drop. At the time, this was around $73. I think it was $73 when I made my initial presentation. I said, well, let me see if it gets down to 60 and I'll do it. And I'll have you know, it's never even been in the 70s since then. So, you know, you can sometimes be outsmarted. But the fact is that this is still a really good company. You may have to pay a higher price for it. I think it's just phenomenal. I just can never find it when it's on sale. And I'm going to continue to look at it. I don't own it personally now. I wish I had, because the performance since it became an independent company in 2001 or thereabouts has been phenomenal. I think if you put originally $1,000 or in there, it'd be worth like about $80,000. It's really gone up quite a bit. So, in sort of a revised conclusion, is it a growth company? Yes, it is. Is it well managed? Yes, it is. Has any of the news changed my opinion on it? No. What's my revised SSG look at? I have it as a hold. It's actually pretty close to a sell. But I think that this still has the same investment thesis. You just got to be really patient. You're going to have to buy it on the dip. You may even still overpay for it. But the fact is that may be the best time to be able to get it. But I do like Edward Lifesciences. I just can't find it at the price I like. So with that, I'm going to go to Cheryl, and you will start telling them about ExxonMobil.
Thank you, Kevin. I looked at ExxonMobil back in 2020. It was also one of the first stocks that I looked at and that we looked at as a group. It really, I have owned it. I'll tell you that right up front. Next slide, please. So at the time of selection, which was October 27th, 2020, the price was $32.82. They had a 52-week high price of $105.57 in that year, and the low was $52.10. So it had bounced around quite a bit. The closing price currently on July the 15th has been $84.54. So there's been an annualized return since that presentation of 84.34%. The original forecasted 5 years earnings per share growth estimate was 6%. Current trailing 12-month sales growth rate, almost 70%. And the current earnings per share growth rate for the trailing 12 months has been 23.4%. Here is the SSG results summary that was taken from that original presentation. I had an upside downside ratio of 8.7 to 1. The total return was 28.8 using the high PE and 26.3 using the average. So both are very high numbers right there looking at it. The buy price to satisfy the upside downside was $43.50, which was below that price at the time of selection. And so I would have done very well, and I did very well buying it back then. Next slide. This is the last fiscal year ends at last December. This industry, it's an oil and gas integrated. They do pretty much everything that is concerned with oil and gas. And it's in the energy sector. We all know it's a very large company. It's often been in the past at the very top of companies and their sales. So it's greater than 10 billion. As I said, they do everything you can think of. They explore for, they produce, they refine. They've got the gas stations everywhere. So they're selling the refined product. So people recognize ExxonMobil. It used to be just Exxon, and then they acquired Mobil and synced the names together. It's the world's largest refiner of oil, putting out 4.6 billion barrels of oil per day, and also the largest manufacturer of commodity and specialty chemicals. So those are the three sections of the company. They do the upstream, which is taking it from getting it out of the ground and putting it into the gas stations. They do product solutions, mostly with those specialty chemicals. And they also are into low carbon solutions, trying to get on the bandwagon along with a lot of other companies in reducing the carbon effect on the world. Next slide. So what I did is I looked at the industry studies out of Value Line, are very good places to start to look. And as I said, because Exxon represents doing everything within the industry that you can think of, to me, comparing those two industry studies from November 2020 to now really gave me a lot of good information on what's going on with that industry and with the company itself. You can see that the ranking, they look at 100 companies and they do a ranking within the industries. And so it's 95 out of 100 back in 2020, whereas now it's 65 out of 100. So it's moved up the ladder in terms of how Value Line was ranking it. Again, back in 2020, we know what happened then. Very few people on the road. There wasn't a demand for the oil because people weren't driving. And so they sank to probably the lowest that they had been in a long time. They'd had some other things happening along the way that had also hit the energy industry, but that really was something that really got to them and caused the prices, not only of the company, but also the price of the economy and the oil prices. It went to a low of $40 a barrel, and it was headed for a sharp pullback that year. But they didn't know, of course, that COVID was going to continue for as long as it did. And now we're looking at it in May 2020, complete turnaround. The industry's performance and the prospects have improved, elevated oil prices, more people out there driving. And I can see that every time I get on the highway. And then there's also a limited global supply, thanks to the not only the manufacturers and the producers of the oil, but the global situation of what's happening in Ukraine and Russia. And also the refiners are posting a much improved results. Next slide.
Cheryl, you're at the 6-minute mark.
Okay. Here is the prior SSG that I did when I first presented. And you can see earnings per share is way down from a year ago that quarter. And look at the percent change, 135% drop and a 52% drop in sales. And there was my forecast of sales 2% and earnings per share 6% versus what we're looking at now. They've got sales are up 52.4%. So it's almost like it reversed. Earnings per share is up 100%. The sales and the earnings per share still haven't moved a lot, but we've got to understand this is a huge company, and for them to put out big doubling numbers is almost impossible, even if they're doing their best. Next slide. Okay, this is the stock study summaries for my 2020. Again, looking back that they're not going to come back to normal anytime in the near future, not when they're down by that big a number, that I'm going to keep doing my updates and comparisons so that I can get at some kind of an idea of when the industry might be trending back towards normal and also which company might be the best of breed. And again, with my current summary, that when industries, whatever, fall out of favor for whatever reason, doing regular SSG studies along with fundamental technical resources and peer studies may be helpful to detect positive directional changes over several quarters. Okay, and I believe that is my last slide.
These are just, this was your original conclusion.
Okay.
They can read that. And then, so let's go with this last one. So what's your thing? Do you still think it's a large size, slow growing company?
Oh, definitely. Definitely. As I said, when you've got something that's that big, it can't help but slow it down as opposed to some nimble little small company.
Still well
They're
managed?
still a very well managed company. They're being somewhat flexible, especially as I talked about. They're bringing on a section that's looking at low carbon results, and haven't seen any real big news to change my opinion on Exxon itself. It's showing up as a buy, but again, you're at higher prices than you were, but as being a buy, it was, I believe, 3 point something to 1. It still is looking like it's going to go higher. So I still think they have a workable investment thesis.
Okay, thank you. All right, Jonathan, why don't you tell us about Regeneron?
Okay, Regeneron has done quite well. It's up 21% since our original presentation. Next slide. The price at the time of selection was $481.30. It's reached a high price of $747.42. And the closing price is $607.54. And you can see on the right side, my original summary. It was in the buy zone with returns between 10.8% and 16.2%. Next slide. So a recap of Regeneron, it is a large company. Now, I highlighted large in red because my original presentation, Regeneron was actually a medium-sized company. So within a year, it has reached the large status in terms of company size. 4 of their main products are Eylea, Dupixent, Libtayo, and Regencov. And they develop these products to fight eye disease, cardiovascular disease, cancer, and inflammation. Next slide. So the top spreadsheet is actually from the Portfolio Evaluation Review Technique, PERT, and this is part of the SSG software package. And I highlighted and actually put a red star adjacent to the estimated earnings growth rate. That is my growth rate that I have selected and forecasted that Regeneron should achieve going forward at 11.6%. Now, what PERT allows you to do is to identify companies that are not meeting your growth expectations. So you can see on the left, those pink highlighted boxes are where Regeneron are not meeting my estimated earnings per share growth expectations of 11.6. In fact, earnings per share is down negative 14.7%, and the pre-tax profit is minus 15.3%. Sales, Kevin, if you go down to the very, very bottom of the graph, so my estimated future sales growth rate was 10%. And you can see I've highlighted in a red box that sales has been doing quite well at 17.3% above in the PERT spreadsheet. Now, if you look at the first quarter of 2022, the SSG, you can see I've also highlighted or put a little red circle around the year 2020 at the very bottom. And I put that on both of the baseline and the first quarter of 2022 spreadsheets, so you can use that as sort of a marker. And you can see 2021 was a phenomenal year for Regeneron. They had a huge increase in their sales, pre-tax profit, and earnings. In fact, sales and earnings almost doubled with respect to sales. Sales was 8.5 billion, the baseline, and it's 16 billion currently. Earnings was $30.52, and now it's about $72. And also note that the recent quarters are the open circles. The green, the pink, and the blue open circles represent the most recent quarterly figures. And you can see there's a sort of a downward trend. So Regeneron had a huge bump in 2021, and now it looks like we're trending downwards. And the detailed estimates, these are the analyst estimates, are also showing that their forecasted growth rates are much lower than where the annual and the quarterly figures are at this point too. Next slide. So this is from the quarterly trend graph, and you can see that sales had this huge increase over the last 4 or 5 quarters, but it's starting to trend downwards. Pre-tax profits, similarly, you can see there's a slowing of the growth rate in the pre-tax profit over the last 3 or 4 quarters, and now we're starting to get to a downward trend. Similarly, for earnings per share, there was a little slowing, and now we're into this downward trend, and pre-tax profit is also showing, profit margins is also showing a downward trend. So those are red flags. Those are things to be concerned with, but those are things that I would probably consider continue to watch if I was going to hold this company. Next slide. So these are the 4 main drugs that have contributed significantly to Regeneron's total revenues for 2021. And they represented an increase in 89% year over year in total revenues. However, if you exclude the REGN, that represented a total revenues of 19.7% year over year. So basically what that's saying is that REGN had a significant impact on the total revenues for Regeneron in 2021. And on the right side, you can see that the United States government had obligated itself to purchase almost 3 million doses, which attributed to about $6 billion in sales. However, in January of this year, the FDA revised its emergency use authorization for REGN due to the Omicron variant, and therefore it's no longer authorized for use in the United States. However, it is sold in European countries at this point. So this was one of the main impetus for a lot of the downward projections from the analysts and the downward trending for Regeneron going forward. Next slide.
5 minutes.
So this was my original conclusion. It was a medium-sized company. I think it's still very well managed. It was fairly priced, and I had it at a buy at that time. Next slide. Now, it's a large-sized company, but I think it's at least moderate to fast-growing, and I think it's still very well managed. And you can look at the return on equity, profit margins, and debt to make that assessment. But this is a company, if you own it, I would probably continue to hold it and just watch the quarterly figures to see if there's a downward trend, or seeing how those quarterly data metrics are going to look going forward. Okay, next slide.
That's it. And now you can go right into your next presentation, Jonathan.
Right. Okay. Hershey's had a phenomenal, this has just been a phenomenal company. They have been up 21% since the original presentation. Next slide. So the price at the time of the selection was $178.88. It reached a high of $231.60, and it closed at $216.80. And my original presentation had this in the sales zone. It was overpriced. It was way overvalued at that time, and you can see the total return was 4.2% with the projected return of 1.6%. Now, those returns, half of those returns were also based on dividends. So about half of the returns were using dividends to achieve those returns. Next slide. As a recap, Hershey controls 46% of the domestic chocolate market. They have 90 brands that are sold in 85 countries. They continue to make acquisitions, and this has been a huge plus for them. They recently acquired a new CEO over the last 5 or 6 years, and she has been doing a phenomenal job running the company. Their most recent acquisition was Dots Pretzels within the last year or so. Next slide. Again, looking at the PERT, I've highlighted and put a star next to my projection for earnings growth of 4.2. Now, keep in mind, Hershey is a medium-sized company. A medium-sized company, we would expect to grow between 7% and 12%. I had forecasted this at 4.2%, and much of that was based on my research and my concern that the price earnings ratio at the time was too high, and this company was probably going to start to come back towards its baseline signature price earnings ratio. However, that did not happen. This company has just been firing on all cylinders. You can see the PERT has been just phenomenal. The earnings, all the growth metrics have been phenomenal. Earnings, 35.3%, sales, 16.1%, pre-tax profit, 31.7%. On the far right, you can see the percent total return is only 3%. So even if you bought this company or were still holding it, you're really only looking at about a 3% total return, and the upside downside ratio is less than 1, and that's why that's highlighted in yellow. If you look at the SSG at the bottom, you can see the first quarter of 2022. Again, I've highlighted the year 2020 for comparison and as a marker, and you can see that there was significant increase in sales, pre-tax profit, and earnings in 2021. And they've reached the high price. This is the highest price that they have reached in the last 10 years. In fact, it is the highest price that this company has ever reached. If I was to continue to hold this, company, I would probably redo the SSG. I would do an optimistic SSG because this company continues to just move forward. And a lot of the research that I've done looks like it's still looking very, very positive, and the growth metrics are. The company itself is anticipating earnings per share growth on average between 6% and 8%. So they're looking, their forward-looking growth metrics are still looking very, very good. Next slide. These are the quarterly trend graphs, and again, you can see some slowing in sales, but it's still moving upward. However, pre-tax profit and earnings are slowing, and they've decreased the last 3 or 4 quarters. Again, these are red flags. It's something to keep an eye on. The profit margins are sort of flattening out, but it's still on an upward trend. Next slide. So my original conclusion was it was a moderate-sized growth company, well managed. It was overpriced, and I suggested just watching and waiting and see how the price earnings ratio came down, and look for an entry point. Next slide. Nothing has really changed. It's still a phenomenal medium-sized growth company. It's still very well managed. Nothing has really changed. Nothing in the news has really changed my opinion on the company. Again, if this was a company that I held, I would probably consider doing an optimistic SSG and make a determination whether to continue holding it or taking a little bit off the top, trimming it, or selling it and buying a completely different company. But I would definitely have to redo the SSG to make that determination. And that's it. Thanks.
Thank you, Jonathan. And now we're coming back to me, and I'm going to talk to you about Ollie's. And it's up 17% annualized since we did our original presentation. I think it was October of last year. They are in the bargain outlet venue. Here's what my original SSG is over on the right. It was 3.2 to 1, a 15% return. That was when it was selling at $59.93. Here's where its 52-week high is, and there's its 52-week low. And it's closed up a little bit from where we are. And here, my original growth forecast was 9%, but here's some things that I'm a little concerned with is that the trailing 12 months on sales and earnings are both negative. So here's my original presentation. It had dropped in July from $89 concern was whether it's a falling knife. You know, the concern was is that it done really well during the pandemic because it's a discount store. It's basically for people who like to go bargain hunting, um, and they never have the same sales every day. They're always buying other retailers' um, leftovers, unsold goods, and that therefore they'll use that to buy it for pennies on the dollar and then sell it for just a few extra pennies over it. That's their business model. Um, but it doesn't move. It does have a very cyclical nature to it, and that was sort of masked if you just looked at things through up until the pandemic, because from '09 until February of 2020, we had our longest extended bull market ever in the history of this country. And so even cyclical companies would have sort of these up, straight, and parallel lines that we talk about. And Ollie's is really more of a cyclical nature. Um, Here's some information on this. Their webcast was telling us that they did really well with impact from stimulus. They did indicate that they were going to have supply chain issues, and those were some of the things that were really quite consistent. They do generate a lot of cash because that's basically the way people pay for their goods and services there. They are very low tech. They are not a high tech company at all. Um, Quarterly data. Again, here's my revised sales estimate is right there. It was doing really well, but now look, we've got 4 straight quarters of down on sales. So that's as Jonathan was saying, it's a red flag. If I've owned this stock and it's been up 17%, this would be a time to maybe either take some off the table. Some people use a thing called a trailing stop loss order to be able to protect stuff. Because this is showing some of the fundamentals that we're really concerned with that things can be going down. Pre-tax profit also going down. That's not a good sign. Here's my revised earnings estimate. And again, we see 4 quarters that are below that. So even though it's done really well, I'd want to be a little cautious. I think the thesis on it is still good long term, but you may want to be a little careful with this. It's probably a little bit more on sale now, but I'd have to be cautioned with all of this stuff, with those quarterly numbers going down, that I'd have to tread very carefully on this. And that's the reason why using some technical measures, which we generally don't always use in better investing, but I think something like this, if you were to put a trailing stop loss to protect it if bad news comes and it comes quickly, you'd be able to hang on and still make some of your profit. So where is it now? It's still a steady grower. It just is not, it's really more in the cyclical field. Is it well managed? Yeah. Is it the greatest? I don't think so, but it's a good managed company. There's nothing in the news that's really changed my opinion. My revised one, I have it as a buy, but the thing is that with those fundamentals, if the fundamentals are going down, the valuation can have this thing make it look like a screaming buy. So it's a buy with sort of a caveat, and you got to be careful. Is it still got a workable investment thesis? Yes, but you have to sort of realize they deal in very tiny margins, and they have to be really good at being able to buy other people's leftovers and be able to turn that into cash for their own stuff. So it can work. I think it's a really interesting company, but you'd have to be with the fundamentals of where the last couple of quarters are. Be very, very careful with that. Okay, so we've now gone through 5. And I think now, Cheryl, do you want to be able to release, or should I do it, the voting on this? How should we do that? There we go. So we're asking everyone here, of these 5 that outperformed the market, which one do you like the best that you'd want to research a little bit more? We'd like to be able to get as many of you out there to vote. We're up to about 25, 30% of you are voting. Boy, we're really seeing some good movement. 59, can we get up over 70? Can we get up into the 80? Couple more? 75. I think that's probably about where we go ahead and close it out. And there you have it, is that everyone likes Edward Lifesciences, which is great. It just, I don't think you can find it at a really good price. But if we're patient, we can do it. So anyway, very, very good. Again, this will all be part of the recording, so it will be up on YouTube, so you'll be able to take a look at it later. Let's do this now. Let's go to our, close that out. Can I become the presenter now? Let's see. Can you make me the presenter again? Thank you. Okay. Can everyone see that we're up to Qualys? Is everyone else seeing that? Yes? No? Jonathan? Ed, can you see
Yes.
that? Okay. Ed, why don't you take it away?
Yes.
You got the next two.
Good evening, everyone. I'm going to be doing Qualys. This was one of several picks that I kind of presented over the many sessions that we've had here. Next slide. So you can see the same statistics that we've kind of covered for the other stocks. In this case, I want you to just remember one key thing out of here, and that is that this stock was a hold. And maybe a second thing to note would have been we had some pretty lofty sales and EPS growth. And we'll talk a little bit more about that a little bit later. Next slide. So one of the things I'm doing with my two presentations is kind of looking at some of the macro assumptions that I made when this stock was presented. It's one thing to kind of take a look at detailed analysis of estimates for earnings and sales and things of that sort, but I personally depend a lot on whether there are major forces at play that will influence the stock's performance going forward. So for Qualys, one of the key factors for this is that it is a major player in the area of cybersecurity. So at the time, I identified that as a major driver for growth. I still think that driver is in force today. Secondly, Qualys has something called a moat. Specifically, the type of moat it has is high switching costs. In short, what that means is once someone buys your product, it's really expensive. It's a pain for you to switch to a competitor. So those are two things that I think Qualys had going for it and still does. Next slide. So I did want to take a look at where some of the fundamental numbers were going. I did the same thing that Jonathan did earlier, which was to kind of highlight towards the bottom here the 2020 performance, just to calibrate you a little bit. On the right-hand side, I look at where we stand right now, and there are three things I want to draw your attention to. And that is, one is that sales continue to rise and rise in a consistent manner. This is pretty important, again, because it is it has a moat. We want more and more people to be buying the product, and therefore there's a certain stickiness associated with it. The other thing I want to note is that there was a drop for 21, but is back on track in terms of the EPS and pre-tax profits. Next slide. So the other thing I wanted to know, when we did the analysis initially, one of the things that stood out for Qualys is that it was one of the few, in fact, it was the only one within the peer groups that I had identified that had earnings. And so in the area of cybersecurity, there are a lot of new starts and IPOs and things of that sort. So the earnings was a pretty attractive thing to me. It turns out that I believe that to be one of the factors that kind of helped the stock as we have seen its performance going forward. And one of the major trends you're going to hear from me on this stock, as well as Nvidia in a few minutes, is the market-wide movement towards lower PE ratios. So we can track earnings, we can track sales, but if the market says we're no longer willing to pay high PEs for these high growth companies, as the icon on the right-hand side shows, they're going to take a beating. And in fact, a lot of the stock market, in particular, high-flying, high-growth companies have been victimized in the last year, probably half year. Next slide. So some final thoughts on this, and remember, I noted that the recommendation was to hold. And further, the recommendation is that you could buy at 127. So I wanted to show you a little bit in terms of if we had bought the stock actually at the recommended price that the SSG analysis pointed to, which was 127.40. Yeah, we would have bought it probably within a week or so after the SSG, and you would have seen that it would have continued to fall. And it would have been quite the ride from back in when the SSG was done till today. I would note a few things. One is at the very end, you'd be only a few dollars off of the purchase price after this pretty interesting ride that you would have taken over the last year and a half. The other thing that you would also notice is that if you would have taken a look at the drops at the very beginning, you would have seen that the CEO had health problems. You would have seen that there was a vulnerability discovered in their software, which gave it some bad press. But if you still believed in the basics of the company, so back in the March of 21 timeframe, you could have bought more, and actually this might not have turned out to be quite the bad choice that initial metrics pointed out to be. Next slide, please. So this was the original conclusion. I think pretty much as we go on to the next slide, a lot of the things are still in play. It is still relatively low company. It is still growing, well managed. It has a very strong niche position in the important area of cybersecurity. I'd have to redo the SSG, but I think a lot of the basic elements are still in play. So it might be a hold, might be a buy. But it's certainly in the ballpark of where it was a year and a half ago. That's all I have. Thank you.
And right back to you, Ed.
Okay. Nvidia. Next slide. So at the time that we did this analysis, there was a recommendation to actually buy. So I'm not going to have some of the same financial analysis I just did with Qualys being applicable here. At the time, next slide. The macro trend for me is that, and I still believe this to this day, is that Nvidia has been and continues to be the premier player really in the world of artificial intelligence. It is responsible for the most popular and widely used GPU chips. They also provide a lot of the underlying software ecosystem for people to do artificial intelligence, do their deep learning algorithms. So anything sophisticated generally has Nvidia on its perimeter. Next. So I did the same thing here with comparing the two time frames. The one key thing on the right-hand side I want to note is that they're in the short term, we're seeing some flattening of EPS and pre-tax profits. We continue to see growth increasing for the stock. So that bodes well. This last quarter could be a little bit of a sign that one would want to look at a little bit carefully. Let's move on. So in this slide, I want to take you through a little bit of a journey here. So on number one would have been when we bought the stock, right? It was the analysis was done and we buy it at 242.80. And then basically a pretty short time later, that thing reaches the price all-time high of $346.47. I want you to remember that number, although I'll repeat it because it's important for some more analysis that I do later on. At the same time, one could have taken a look at number three, which is that if you take a look at a fairly sizable time frame, you see that the PE ratio operates between two boundaries. Now, those are pretty high numbers. 75 to 100 is pretty outrageous, but nonetheless, it is a sustained trend during a pretty significant amount of time. What's important to note is that as the stock was reaching its all-time high at number 4 there, it was also breaking the historic boundaries for PE ratios. That could have been a clue for folks that at 115, a PE of 115, this thing's on fire and you need to put it out, i.e., you might want to consider taking some profits. This is just when a stock goes that crazy, you got to learn to take profits. That's one of the major themes I want to kind of highlight here. So say you don't take action there. You see the PE fall back into a normal range. In 5, you see there are 2 opportunities when the PE ratio falls below the historic lower limit of 75 for you to sell it. Now, if you don't sell it, then you wind up at number 6, which is, as noted on the first page, was about 30% down from the initial purchase price, and a pretty brutal 54% from its all-time highs, which was illustrated here in number 2. So I wanted to take you through a journey in terms of tools and things that you can do as you own a stock to figure out, hey, am I having trouble? And some of this is beyond just looking at earnings and sales and profit margins. Next slide. So in that initial analysis, I don't want to say I told you so, but there was a point that said, hey, this is worth buying, but it's a risky stock. You got to look at it real closely. I gave you just a good example here in the previous slide of one of the things that you could have been looking at very closely. Next slide. Also, you might think that the SSG would have been helpful. The buy point for the SSG when we did it was 370. We almost got to that point at the all-time high of 364.70. I'm sorry, 364.47. But it just wouldn't have gotten there. So the SSG and this mechanism here wouldn't have been the trigger. So no help from the SSG, and at least from this artifact. Next slide. So again, if you're going to invest in something risky, the lesson learned in terms of this, you got to track it closely. No stock goes up to infinity, no matter how many times you click your heels and wish it to be the case. Going forward, I think Nvidia's prospects are strong, but boy, is it a risky roller coaster ride. They have, what's the acceptable PE for Nvidia? I think people are trying to figure that out. You got all these other factors, socioeconomic factors that all complicate your ownership in it. And by the way, just a final note, it would have been nice to catch that 58% gain in 79 days. But if you're a long-term investor, chances are you never would have caught it. You would have been kind of sadly looking at the price as it dropped and looking to see what mechanism you're going to use to objectively get out of the stock, certainly before where it is now. Next. So those were the initial conclusions. Next slide, please. Still a very good company. It is the premier company, but as a trade, maybe not as an investment. This just needs a little bit too much hand-holding and looking and attention that most of us don't do, and it's sort of not in the mainstream of the BI methodology. Next. Thank you.
Thank you, Ed. Cheryl, back to you.
There we go. All right, so now I am going to be looking at Medifast, and we can go to the next slide. So Medifast, here is my original selection price, was $279.17 back in end of June 2021. For that 52-week period, there was a high price of $295.38. and the low price was $154.67. Now the closing price as of July 15th was $171.83. So they did also take a haircut, as some would say. So the annualized return since that presentation, they were down 35.74%. The original forecasted 5-year earnings per share growth estimate was 12.2%. The current trailing 12-month sales growth rate was 46.1%, and the current trailing 12-month earnings per share growth rate was 32.4%. Back in June of 2021, I had it as a buy of 3.7 to 1 with a total return of 15.6%. with a projected return using an average PE of 7.4 and you could have bought it at a price of 286.9 if you could find it at that, to get it a 3-to-1 and 15% total return. Next slide. So Medifast is a US-based company. They produce, distribute, and sell products concerning weight loss, weight management, and healthy living. The company generates its revenue from point-of-sale transactions that are executed over an e-commerce platform for those different products, and they also have consumable health and nutrition products. The last fiscal year ended the end of 2021. The industry is personal services, and the sector is consumer cyclical, with a medium-sized company of 1 billion to 10 billion in sales, which I also have in red. So remember that this is showing it as medium. And there's your 3 different parts of the revenue. They have the products and program innovations, the optimized systems, processes, and partnerships, and that Optavia, which I shall go into a little bit more describing that. So go to the next slide, please. So value line back in this current one in 7/8/22, the commentary, it's a solid first quarter performer. The revenue surpassed expectations, grew a robust 23% year over year. Earnings were modestly higher than last year's blowout, and as been discussed before, and when you've got a year in the pandemic where everyone's staying home and trying to do things to keep their weight in check, you're going to have blowout earnings, and then you can't just keep that growing. So Optavia is where they are taking people who were clients, and now they're going to be growing them into coaches. And that program grew 22%. And so those customers then becoming new coaches, they further support the growth in that first half of next year. So this Optavia model continues to gain users. It's increased 57% just from the last quarter. Management raised its full year guidance. So despite some short-term margin pressures from continued investments in technology and, of course, the ever-present supply chain infrastructure and inflation, but they're still saying the company should benefit from tapping new markets and increased fulfillment capability. So company expects revenues and earnings momentum to continue next year. So they're refining their focus on new distribution center in Texas that's going to be coming up in the second half of this year. They also have enhanced automation and a $500 million increase in manufacturing capacity beyond what it was last year. And then separately, they're going to be opening a product innovation center in Maryland to support anticipation of rapid growth. So they're saying over the next 3 to 5 years, there's going to be capital appreciation potential, and they believe there's room for these shares to run and for the price to earnings multiples to expand. Next slide.
5 minutes.
Thank you. Here is looking at Medifast, the SSG graph from when I first did it back in 2021 to versus now in 2022. You can see still sales are going gangbusters. Earnings and pre-tax profit, as I said, have dropped a little bit from the all-time highs that they got last year. But look at that price bar. Back in 2021, it's near the top. 2022, it's down near the bottom. There's the big difference right there. The sales in 2021, they were up year over year, 90% for sales, earnings 121%. And again, you're having a little bit of a downturn from a gangbuster year from last year. Sales are only up 22%, earnings only up almost 4%. But they're still having those gains that they had from last year that they're having to kind of compete against themselves for. I'm looking at the forecast for 2022 to come down a little bit in sales, but up a little bit in earnings to kind of level out from in the 5 years. Hence, next slide. So here is the stock study summary. The one I did back in 21. They were a small size company. And remember, I told you to pay attention to what it's being posted as now as a medium size. So that small size explosive growth has gotten them now to be a medium size in terms of sales growth. They're still a well-managed company. They've made acquisitions that will allow them to sustain long-term growth, and opposed to acquisitions now they're growing it through that Optavia. And so that is seeming to be a better match for them. They were fairly priced back in 2021 at $284.22 with a PE of 26.9, which was above historical averages. And if you look down into the 2022 summary, that stock prices dropped around 40% to $168.45 with a current PE of 12, which is less than half of what it was back in 2021. And so Medifast has now grown from being just a fair company to put maybe on a watch list and watch, to actually being a worthy buy, or if you've got holdings, to add to those current holdings and taking advantage of cost averaging. Next slide. Okay, in conclusion, from my original, again, small sized, well managed, fully priced, a buy up to slightly above what the price was then, and worthy candidate. The next slide. Small sized, but gone up into now a medium sized company. It's still well managed. The news on Med has slightly changed my opinion with that Optavia. I really like what they are doing, where they're taking their current customers and turning them into coaches to motivate future customers. It's a buy, definitely, and it does have a workable investment thesis.
Thank you, Cheryl. Okay, we got two more, and hopefully we'll get through these pretty quickly. I've got the two biggest dogs that we've looked at over this time. Etsy, when it was presented, it's been down 42% annually since we first looked at it. I think it was like in the spring of last year. Yeah, it was the May issue. My original estimate was it was a buy. It was 17% total return. If we use the par, it'd be 13.5. It was selling at 198. Here it is. Its closing price right now is $82. So it's really, really dropped. My original estimate for earnings were 30%, very, very optimistic. And the trailing 12 months has been 15, and the earnings is a negative, really 15. Here's from my original presentation. Etsy is, they sort of have a sort of craft artisan group. They're out of Brooklyn, and very, very interesting in terms of it's sort of like a niche sort of Amazon place where people can come on in. Yeah, a lot of sellers that go back and forth. They have a much better interaction with Etsy than they have ever felt with like Amazon Marketplace. Amazon Marketplace has not really gone into their niche. They think that they still have a total addressable market of 437 billion. That's worldwide. And they are still looking at seeing some really good 5-year sales growth at 33%. and they really have almost as much cash as they do debt. So they really are able to take care of things. From their original presentation, this is sort of where Etsy thinks they're going, is that they have a niche that sort of people want to be with. It's a trusted brand. They have a collection of unique items that Amazon or anyone else doesn't really have. And they show up, again, they're pretty much in the English speaking worlds. If you look at the countries in which they are, with the exception of Germany, all the rest of them are predominantly English speaking. So that's sort of where they are. If you look at the latest quarterly numbers, again, here's the sales. There's my sales estimate. It's been revised. It did really, really well. It's now coming down below that. So it's the first sort of indication, but it's been trending down. Some of that's just because they had they did really well during the pandemic, and it was hard to be able to keep those numbers up. If you look at the pre-tax profit, it's actually relatively straight, not too bad. So I wouldn't worry too much. Again, here's the line for the revised earnings growth, and you can see again it sort of peaked. This is at the end. This is 1 year after the pandemic began, and now you can see when you have quarter over quarter changes, it's really kind of hard to keep up with it. But it could still really sort of stay in that area that it could be growing at maybe a 20%. I still think it's an explosive growth. If you look at the value line that came out in May of this year, the most recent one, is they think it still has they're actually really quite optimistic. Originally was overpriced. It was trading above its 5-year average. So I thought it was a good candidate it could be a candidate to purchase, but I thought it was a little bit of a high flyer, and I think you'd want to wait for it. It did. It did crash down to earth. If we look at it here, it's still a medium size. There's still a lot of growth with it. It's still well managed. I think it's just one of those, like Ed talked about, it just had these sky high PEs and they were unsustainable. But now that they've sort of been shaken out, this is something to sort of take a look at, and you may want to be able to see this as something going forward. I think it's still either a buy or a hold if you're patient and willing to wait out a year or two. All right, the final one, Carnival. This is our biggest dog of this. It's been down 68% since we first presented it in July, basically a year ago, when the entire market is down about 11 or 12%. This one's down 68, so it really got hammered. As you can see, it was originally proposed at $24.24 for the price. It's currently selling at $9.18. I even had a negative earnings growth because of the way the SSG is situated. Here's some caveats: is that the sales growth is really healthy at 15%, but it's coming from a really, really low number. And this trailing 12-month earnings rate is because they're negative numbers that have gotten less negative, but they're still negative numbers. So that's a real caveat I'd be careful with. World's largest cruise line, they grow by acquisitions. They have to be getting their cruises out to be able to get the money out to be able to take care of things. They redid their debt to be able to keep things going during the pandemic. It is a turnaround play, but it's a turnaround play for maybe the for those that aren't faint of heart. From their annual report, originally they showed all the things that they did to sort of stretch out their debt with all the ships that they had, and it's still a real big concern. I looked at this as what I said originally. I said maybe we ought to consider dropping it, but I did walk through it. I was a little bit concerned with some of those things. And this is an example of when some of the fundamentals are down, it's really, really hard to be able to sit there and come up with good numbers. Again, this is a stock to study, so this is sort of has a 5-year horizon, and we're only a year into it, so maybe it can still come around. These quarterly numbers are not going to be as beneficial because if you look up here, these are in the 1,000% because this is so high that you don't get to really see those numbers. But it's really sort of jumped, but that's, again, I think it's illusionary because of the fact that everything is, they're off of very, very small numbers. If you look at these overall, it's holding right about where their numbers are, but you just got to be really, really careful and patient. It's a prime turnaround. It is fairly managed in the cruise industry, but the overall market is, are people going to continue on cruises going forward? And that's the biggest thing. I do know some people that love their cruises and go on it, but are there going to be the casual cruise goers, and are they going to continue going forward? It's not a traditional BI company, and you have to sort of look at you have to maybe take some of the risks that go with it. So it's a slow grower. It still has a turnaround, but unless you really have sort of a long 3 to 5 year horizon and you're going to be really patient with it, you probably wouldn't want to hang on to it. It's still, there's just so many things on there. There's just like, why would we even want to hang on to it? Good thing we didn't purchase it or even make it one of our selections. So now we have 5 underperformers. And Cheryl, do you want to release the second poll where we'll vote on the 5 ones that underperformed, and let's see how they all did. So we'll be looking at Qualys, Nvidia, Medifast, Etsy, and Carnival. So go ahead and vote. You have about 40% of you voting. Glad to see all of you are still hanging in there. We haven't lost you yet. Up to 60%. See if we can get up. Can we get up into the 70s, mid 70s? We're at 65. Any more? 68. Let's see if we can get 1 or 2 more votes. There we are. 1, 2, 3. Okay, let's go ahead and close it out. And there you have it. People think that Nvidia has some stuff. I'm not surprised that no one wanted Carnival. I was very pessimistic about things going forward, but Medifast was also in there and looked really pretty well. Thank you, folks, for doing it. Now we have just sort of our final stuff. We can start to take some. Go ahead and make me the presenter again. You just seem to have. Thank you. Okay, so we went through things very, very fast, but and we didn't give you the SSGs, but again, there's the handouts to take a look. But if you have any questions, you can reach us at diggingintothebi@gmail.com, or you can reach us either at the Maryland or DC chapter. Again, there are some of us that were at BINC. Again, join our mailing list from the DC regional chapter. We're really good about getting out messages there, thanks to Carol. So sign up. You don't have to be in our chapter, and you will get there. Jonathan, why don't you tell us about volunteering and what people can do?
Sure enough. I really believe if you want to be, one of the ways to be a successful investor is to join an organization. There's strength in numbers. So joining an organization with like-minded individuals can significantly improve your investing success by education. So you can make a difference in someone's life also. Next slide. By becoming a volunteer. So there are hundreds of volunteers working in the background every day with your chapters, the headquarters nationally. Many people are coming together, working together, and trying to create an optimal educational and learning environment to improve your investing success. And you can also participate by becoming a volunteer with our chapter. So there are many benefits in volunteering. And you can see below under the chapter volunteers, you can learn new skills, you can hone their investing skills, you can educate others, you can help plan local events and classes, and then you get discounts too. Discounts on some of the subscriptions, club membership dues, the national convention. So it is truly a rewarding experience by volunteering and helping others. So we encourage you to go online to the Better Investing website and look up information on becoming a volunteer. And again, make a difference in someone's life. Thanks.
Thank you. Okay, we do have some questions lined up. Ed, you've been sort of tracking those. Can you sort of take us through some of those questions and parcel them out?
Well, actually, I just sent out a note to everyone. We had gotten an earlier question that Jonathan answered, but I think it's kind of interesting. The question was from Robert, who asked about Nvidia and Qualys. Where did we get the historical PE ratio information? And as Jonathan responded, it was out of Big Charts, which is one of the features you get when you're doing an SSG under the Research tab. As a side note, there aren't too many places that easily provide that information. So depending on what you use to do your overall analysis here, like if you're in Fidelity or TD Ameritrade, I'm not so sure that they have that easily available to you. So that's a great resource from the BI. That's the only question that we've gotten so far.
Okay. If anyone wants to raise their hand, we can be able to pull you out if you're so inclined, or type something there. We can unmute you if we can keep track of things. You have any hands up? Let's see what we got. No hands up. Boy, we must have done everything perfectly.
Yeah, that's it.
Outside of the first couple minutes where we hit a glitch, so sorry about that. Anyway, if there are no other questions, why don't we just sort of finish with the last stuff? So again, next month, we talked about this last week. Those are the stocks we're going to be looking at. And come back and see us. Again, visit us up on YouTube. We'll try to get this up either later on tonight or tomorrow. And the YouTube video can be shared with anyone. We'll put a link up on the Facebook page so that you'll be able to find it. Thanks for all the people that were at Facebook that shared it out. And we'll go back to our regular presentations at the beginning of each month. So thank you.
We have one more. We have one more poll.
That's right. Oh yeah, before we go, I'm sorry. You want to release a poll?
What am I doing? And we're referring, when we see webinar helpful, we're referring to these special webinars where we are looking back at the stocks that we've covered over the last few years that we've been doing this.
And getting this feedback will definitely help us. This is the first time we've done a review. We weren't really certain how to do it. It went longer than we all sort of hoped, but we sort of realized that we were going to fumble around with this just like we did with our original stuff. Looks like we're sort of stopping there. So why don't we close it out? And I did see a hand go up. So let me see who had their hand up. Did see someone with their hand up. Maybe they took it down. Yeah, looks like we have no one else here. So thank you very much. Please stay in touch with us, and we will see you next month when we dig into the BI.
Good night, everybody.
Good night, everyone.
Take care.